Hey guys, welcome back to the channel. In today's video, I'll be sharing with you my Reminiscence of a Stock Operator summary and some of Jesse Livermore's strategy. This book, The Reminiscence of a Stock Operator, is written by Edwin Lefevre. I hope I'm pronouncing his name right, but Edwin is not Jesse Livermore. So how does this relate to Jesse Livermore and Jesse Livermore's strategy? Reminiscence of a Stock Operator is a thinly disguised biography of Jesse Livermore's life. So this book shares about Jesse Livermore's experiences, his thought process, his strategies, and how he approached the stock markets. And these are the 5 lessons I learned from Reminiscence of a Stock Operator. The first thing that I learned from Jesse Livermore is that the big money is in the trends, and it is not in the small price fluctuations. And being a short to intermediate term trader myself, frankly it took me a while to internalize this lesson. Because as a short to intermediate term trader, my goal was to capture this short to intermediate term price fluctuations. But Jesse Livermore, one of the best traders in history, realized that the big money is in the trend and not in the small price fluctuations. And his advice was to focus on the bigger picture rather than solely on the price charts. This is not to say that we do not focus on the price charts. However, what he recommended was to have a broader and more macro view of the economy and the stock market, and to also pay attention to the circular trends. And in the book Reminiscence of a Stock Operator, it was being right in these circular trends and longer term trends where Jesse Livermore made big money. Let's take a look at some examples on the difference between the small price fluctuation versus circular trends and the bigger picture. This is a price chart for Tesla on the shorter to intermediate term. There's certainly some price fluctuations for us traders to benefit from. We could have rode on this short-term trend upwards, and then get out at this point where prices fell, and then get back in around here and continue to ride the trend. And we will be able to generate some nice profits doing that. And if we take a look at the bigger picture, the price fluctuation we saw in the previous slide looks like this on the bigger time frame. Instead of trading on those small price fluctuations, we trade based on the bigger picture of things, and we entered here and rode the trend all the way to here. That is where the big money is made. Another example would be Amazon. For this price chart for Amazon, this is the shorter to intermediate term. And similarly for this price chart, there's certainly some price fluctuation and volatility in prices. And as traders, we will be able to generate some profits trading these price fluctuations. If we take a look at the bigger picture, those were just small price fluctuations. And if we would have entered here and rode the trend all the way, that is where the bigger money is made. That is not to say that as traders, we are unable to make profits in the small price fluctuations. What Jesse Livermore believed, through his many years of trading in Wall Street, is that the bigger money is made in the trends rather than in the small price fluctuations. This is a quote by Jesse Livermore. He mentioned that is about all I have learned, to study general conditions, to take a position and stick to it. So he would study the broader market and then establish the direction of the line of least resistance, and then he would take a position and stick to it. So that is the first lesson I learned from the book Reminiscence of a Stock Operator and from Jesse Livermore, that the big money is in the trend. The second lesson that I learned is to never act on tips. And Jesse Livermore has this to say: a man must believe in himself and his judgment if he expects to make a living at this game. That is why I don't believe in tips. Some tips might be downright bad. However, even good tips can be bad. Let me explain using an example. Say you went to the doctor because you had a tummy ache. But when you see the doctor, instead of asking you what's wrong, the doctor just prescribed medicine for you. And the medicine is for cough instead of tummy ache. So is the medicine for cough bad? No, because if you had a cough, the cough medicine will work for you. However, you didn't have a cough. Instead, what you had was a tummy ache. So good tips also work the same way. The tips by themselves might be good, generally speaking. However, it can be bad for certain individuals because it may not suit the individual themselves. For example, the tip may be a long-term investment, but for the individual who is a trader and who is focused more on the shorter to intermediate term, the good long-term investment tip might be a bad short-term trading tip. Of course, as traders, we can take into account the opinions and suggestions of others, but we should not take the trade unless we agree with the trade. So maybe you receive a tip or a suggestion, you go and do a bit of research on this tip, and from your own research and study, you agree with the trade yourself, then taking the tip to make a trade for yourself is okay. What we shouldn't do is act blindly solely based on the tip. And that is the second lesson that I learned from Jesse Livermore. The third lesson that I learned from the book Reminiscence of a Stock Operator is on the topic of buying and selling. The first thing that I learned from the topic on buying and selling from the book is that as traders, we shouldn't try to pick the exact bottom and exact top. Jesse Livermore believed that one of the most expensive mistakes that a trader can make is trying to pick the exact bottom and exact top. And as traders, being able to identify and trade just the middle portion of the trend can allow us to make substantial profits already. One possible reason why some traders want to pick the exact bottom and top might be because of ego. They want to boast on social media about being able to pick the exact bottom and exact top of a price movement. And Jesse Livermore believed this is one of the most expensive mistakes that a trader can make. The second thing that I learned on the topic of buying and selling from the book is to act immediately when the price chart signals to us that there is a price movement on the way. Some traders, when they see that there's a price movement on the way, they don't act immediately because they want to find out the reason why price is moving like that before taking any action. And Jesse Livermore believed that more times than not, these traders will be left behind and they won't be able to participate in this price movement. He mentions that of course there's always a reason for fluctuations, but the tape does not concern itself with the why and the where. He said that as traders, our business is with the tape is now, not tomorrow. The reason can wait, but we must act instantly or be left behind. The third lesson that I learned from Jesse Livermore is scaling into positions. What scaling into position as a trader means is that we do not want to enter a full position at the start. Rather, we want to stagger our buy positions. So we want to add and buy our positions as prices go up, or short and sell when prices continue to go down. Jesse Livermore believes that it is important not to enter a full position at the start. Let's take a look at an example. Say we want to buy this stock, and we have determined that the total number of shares that we want to buy in this company is 30. So Jesse Livermore's strategy and what he would suggest is that we stagger our buy positions. So at the start, we want to buy 10 shares at $10. And as prices continue to go up, we want to add our positions. So at $12, we want to add another 10 shares. And as prices continue to go up, we will continue to add even more shares. So when prices reach the price level of $14, we want to add our final 10 shares. And that is how we scale into our positions. Now, some of you might be thinking, if prices are going up, why don't we enter a full position of 30 shares at the beginning? Which means that we will buy 30 shares at $10. If we have bought 30 shares at $10 at the start, instead of 10 shares at $10 and then another 10 shares at $12 and then finally another 10 shares at $14, for the 30 shares at $10 position, we would have made even more profits compared to the scaling up positions. However, if prices don't rise up and instead prices fall, then we would have suffered a way bigger loss by buying 30 shares at $10 instead of 10 shares at $10. And that is why Jesse Livermore said this. It is a wise thing to have the big bet down only when you win, and when you lose, to lose only a small exploratory bet. So what Jesse Livermore would do is that he would buy a partial position in the markets first, and that partial position in the market would act as a probe. So if the markets rise after he had bought, then this would have proved that he was right on the trade, and he would add even more positions. This gives Jesse Livermore further proof that he is right in the markets, and that is also when he will continue to add even more positions. And that is how he accumulated a big position in the markets when he wins, and made big money when he won. And when he was wrong, he only lost a small amount of money, because he was only losing a portion of his position in the markets. The fourth lesson that I learned from the book Reminiscence of a Stock Operator is that the greatest enemy or the greatest barrier to success in the stock market is not external things or people, but the trader himself or herself. And Jesse Livermore, one of the most successful traders in the world, realized this for himself. He mentions that a stock operator has to fight a lot of expensive enemies within himself. An example of this enemy within is emotions, the emotions of fear and greed. And these emotions can affect us when we trade in the markets. For example, when we are generating small profits in the stock market, fear might kick in and we are rushed to take profits. And instead of letting our profits run, we take small profits. And this is because of fear. And when we are losing a bit of money, we become greedy and we do not want to take the small loss. Instead, we still harbor some hope of at least breaking even. And all these emotions can and do affect our trading in the stock market. And because this enemy is within, it is one of the most difficult enemies to overcome. And that is why so many traders are unprofitable in the stock market. It is not because of external circumstances such as the lack of knowledge, but rather it is the internal circumstances that prevent these traders from being successful in the stock market. The fifth lesson that I learned is the difference between long shots and sure money. And Jesse Livermore has this to say about the topic. A professional speculator is not looking for long shots, but for sure money. And I think this applies to both investing and trading in the stock market. As investors, we always want to look for the next big thing. The next Google, the next Facebook, the next Amazon. The kind of stocks which can appreciate by more than a few 100% over time. And trying to profit from buying the stocks of these companies who are touted as the next big thing are considered as long shots. Because for every Google, for every Amazon, and for every Facebook, there are many other companies which have failed. And this also applies for trading. As traders, we are always looking for companies that can appreciate rapidly within a short period of time. But the very same companies which can experience this rapid rise in stock prices also tend to experience huge drops in stock prices. Fortunately for us as investors and traders in the stock market, we are still able to make money and be profitable in the stock market without having to invest and trade in such companies. What Jesse Livermore recommends is to invest and trade in companies which are almost a sure thing. And this exchange between Jesse Livermore and one person sums up his thoughts about long shots and sure money. Jesse Livermore mentioned that if you are sure you wish to make money in wheat, just you watch it. Wait. The moment it crosses $1.20, buy it and you'll get a nice quick play in it. And the person replied, why not buy it now at $1.14? Why buy it at $1.20? it seems a mighty high price. And Jesse Livermore has this to say: do you wish to gamble blindly in the hope of getting a great big profit, or do you wish to speculate intelligently and get a smaller but much more probable profit? Right, so as investors and traders in the stock market, we want to focus on companies which has a high probability of making money for us, rather than companies which has a long shot of becoming the next big thing. Those are the 5 lessons that I learned from the book Reminiscence of a Stock Operator. If you are interested in learning more about Jesse Livermore, I have another video over here where I share some of Jesse Livermore's trading method from his book How to Trade in Stocks. If you have enjoyed and learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And don't forget to subscribe to this channel if you haven't already subscribed to it, because each week I release one new video about investing, trading and the stock market. And I'll see you in those other videos. To your financial success.